The inverse head and shoulders pattern is a bullish reversal pattern that typically forms at the end of a downtrend. It signals a potential shift from a downward to an upward trend. The price declines to a trough and then rises, forming the left shoulder. The price falls again, forming a lower trough than the left shoulder, and then rises, forming the head. The price declines again, but not as low as the head, and then rises, forming the right shoulder. The pattern is complete when the price breaks above the resistance level, known as the neckline, which is drawn through the peaks of the left shoulder and the head. To identify the inverse head and shoulders pattern, look for 3 successive troughs with the middle one, the head, being the lowest. Draw a line connecting the peaks between the shoulders and the head. This is the resistance level. Often, volume decreases during the formation of the pattern and increases when the price breaks above the neckline. Traders typically enter a long position when the price breaks above the neckline. A stop-loss order is often placed just below the right shoulder to manage risk. The target price is usually estimated by measuring the distance from the head to the neckline and projecting it upwards from the breakout point.